Hello and a good morning from New York and a good afternoon from Brussels. My name is Bart van Ark and I'm Chief Economist of the Conference Board, and welcome on our monthly Economics Watch, which is our monthly program where we inform you on the short-term developments that are taking place in the economy. This is a special edition of Economics Watch because we're going to look at our annual Global Economic Outlook, which we just released yesterday. And this is a chance for us to speak to you on this webcast with some of the core people who have been preparing the webcast, the Global Outlook, and who I will introduce to you in a minute. Here are some of the topics that we will talk about today. Of course, how does the outlook for 2019 look like? What are the key regions that we need to focus on? What are you thinking about the US economy? Do we expect a slowdown during 2019, and how will that materialize? What factors are limiting growth in Europe and in the rest of the world? And we're also going to focus a little bit on the medium-term issues and think about issues like the development of labor supply and the growth of productivity. And of course, we will come back to some of the real risks that we're facing in the economy. One of them, of course, related to the current trade disputes that are there and how this could turn into a situation of a world that from a globalization perspective is going to look very different from what it did in the past. And of course, we'd like you to fully participate with us in this webcast. So please do ask us questions anytime during this webcast. There's a box here that, if you type it into the box on your screen, we can see it here, and I will weave them into the discussion. Also, we of course want to hear from you on your opinions about this webcast in going forward. So take a minute or so if you can at the end of the webcast to give us some feedback in the evaluation. And of course, I'm not going to be on my own today. I'm actually going to benefit from three of the key people on our Global Economic Outlook team, and I start with my colleagues in Brussels. First of all, I'd like to introduce you to Ilaria Masselli, who is our Senior Economist for Europe and has been running the European Outlook as part of our Global Outlook. Welcome, Ilaria.
Thank you.
And next to Ilaria is Abdul Erenbam, and Abdul is our Senior Economist for Emerging Markets, and of course has therefore been running all the emerging market part of our webcast. Welcome, Abdul.
Thank
you,
and then
here in the studio on the right-hand side of me, on the left-hand side of you as viewers, is Brian Shaitkin. Brian is our Senior Economist for the United States, also an anchor on this monthly webcast. He's the constant force here together with my colleague Gad Lebanon. And Brian, of course, as part of the Outlook team, has been focusing on the US. It's great to have you on also, Brian.
Bart, crazy week leading up to the release of the Outlook, midterm elections, falling oil prices, falling stock prices. But on this show, we focus on those long-term, on what you need to look out for in the next year and beyond. So it's going to be a very focused presentation in that way. Looking forward to it.
Right, and that's actually a great introduction into this slide here. I quite often say as Chief Economist at the Conference Board, I only have two roles, and one role is to think about what is the narrative of this Global Economic Outlook, which you find in the title here, and what picture are we going to choose to convey the message. So our message this year is, yes, the global economy is doing quite well at this point in time. You may call it on top of the world. This is perhaps as good as it gets. But then if you look over the edge, there's a lot of uncertainty out there. And the real question is, some of that uncertainty is an upside, some of that uncertainty is a potential downside. And how do companies respond? Are companies holding back because they're concerned about all these uncertainties? Are companies still pushing forward because the opportunities out there are really looking very good? And as we will find in this webcast, although there are definitely significant risks down the road, for the time being, companies are not really pulling back. Investment is strong, labor markets are doing quite well, there's a lot of hiring going on, but we have to look at some of these risks in going forward. So we thought that where we would start actually today is to begin to identify what kind of risks are we actually talking about when we look to that outlook of 2019, and that is what our first poll question is going to look like. It should be brought up on the screen, so you will get a chance to answer this first poll question, and the question here is, which factor creates the biggest risk for the global business environment in 2019? So if you look forward, where do you actually see some of the biggest risks taking place? And we have 5 options here: trade policy uncertainty, political instability, Federal Reserve policy, sovereign debt, or labor and talent shortages. So take your time, pick one of those. They may all five be important, but just pick the one that you think is most important. And then we'll do a quick round with our team here to see how they would respond from their specific perspectives of the part of the world that they're representing. And we'll give it a couple of more seconds for people to respond to some of these risks. 5, 4, 3, 2, and 1, and we're going to close it down now. And that shows that just over half of you actually are most concerned about the trade policy uncertainty. That is being followed by two other factors, political instability and labor and talent shortages, whereas the other two, Federal Reserve policy or debt, are actually much less of a concern. So let's start with our colleagues in Brussels. Ilaria, your first response to this from a European perspective. Does this make sense, or would you change the balance a little?
Totally. No, I totally agree, because today the numbers for GDP growth in Germany came out and they were low and actually negative. So on my side of the world, this makes a lot of sense.
And Abdul, from an emerging market perspective, of course, a large group of countries, but is trade policy the thing that is bothering a lot of emerging markets a lot?
Yeah, I would completely agree with that perspective, actually, because we know that there has been some easing on the trade sphere, uncertainty related to trade sphere after the NAFTA negotiation between Canada and Mexico. But other than that, the China-US trade relationship have been hampering and shaking many emerging market economies and their confidence significantly during the last couple of months, and this will continue, actually. So I think trade policy will be a major risk for emerging market economies.
Brian, from a US perspective, I'm actually surprised that Federal Reserve policy and debt doesn't really come up that high. I wouldn't necessarily have it put it as number one, but actually it comes up quite low here.
And I think labor and talent shortages, which is one of the issues that came in higher, actually helps in shaping Federal Reserve policy, because as labor costs rise, that's going to add to inflationary pressure and force the Federal Reserve to raise interest rates more quickly, and we'll certainly discuss some of the consequences of that. I think the reason why you're not seeing quite as much interest in sovereign debt is simply that I think the EU has done a good job of conveying the message, whatever it takes. In the US, yes, the overall debt burden is rising, but on the other hand, the consequences of that are probably more likely to be higher inflation going forward rather than some sort of debt sustainability risk. And so I think in those two senses, there may be less of a focus on sovereign debt, though that could change quickly given what we've seen happening in Italy. Bart, what I wonder is, what other risks for the 2019 outlook do you think our audience should be focused on?
Yeah, so actually let's go. That's a good transition into the next slide here that you should be able to see now. The way that we've done it this year is that we basically divided our outlook into 7 short-term trends and 7 medium-term trends. And as you said earlier, Brian, we will spend a little bit more time on the medium-term trends also. So I'll go through those very briefly. But overall, we would argue the global economy is still in very solid territory, and we expect it to continue to be the case over the next 6 months. Whether we look at our leading economic index, whether we look at consumer confidence, even business confidence, although it has weakened a little bit under these trade disputes and so on, we would still argue that is a relatively strong factor taking into account. So over the next 6 months, I would say, bar any major policy disruption, and trade disputes is certainly one of those risks, which I think everybody rightly identified. If that is going to escalate, the story would look quite different. But if that's not going to happen, if it stays at the level where it currently is, I would expect the global economy to continue to be strong. This is led by the United States. The US has a strong expansion. That expansion has been supported by fiscal stimulus through tax cuts and spending that has happened this year. That will disappear during the course of 2019, and we'll talk a little bit later about what this means for the gradual slowdown that the US economy is experiencing. Europe is already moderating, and Ilaria will speak about that in a minute. And indeed, as she referred to, the toughening global economic environment is hitting quite a few European countries, which are much more open to the rest of the world than the US economy is, quite significantly. And then for emerging markets, that's actually where I have some of the biggest concerns. Again, I mean, there are many different countries here, but particularly the ones that are external focused, that are relatively open economies, will experience a lot of headwind from the tightening monetary environment and how this is impacting on inflation, on their currencies, and on potential interest rate increases. So, going back to the earlier point that Federal Reserve policy wasn't picked up that high. Maybe from a US perspective, you wouldn't pick it that high, interestingly. But if you were in emerging markets, particularly if you're an open emerging market, you would actually put it up very high. So monetary policy is a key factor here. So are the trade disputes that we will come back to in a minute. But I think you're very right that the labor market challenges that we're facing, and particularly the fact that we're facing labor market challenges in areas where we didn't necessarily expect it, like blue-collar workers or low-wage service sector activities, where we see some of the biggest shortages. That could actually be a real constraint. We're now seeing wage increases of 4 or 5% in some of these industries. Now, to some extent, that's good, because it means that people have more spending power, but it obviously is going to weigh on companies' bottom line, particularly if this goes together with rising interest rates. So I think those are probably some of the most important things to look at. Here is very quickly, we're going to dive a little bit deeper into various regions, but here you see the outlook for 2019, which is the blue bar here. The orange dashes is the current estimate for 2018. So globally, you can see that the forecast is coming down a little bit from 3.2 in 2018 to 3.1 in 2019. Most of that hit is actually taken in the emerging markets. You see a slowdown in China. You see a bit of a slowdown in India, in the rest of Asia. You see a fair amount of slowdown in places like Russia and Central Asia. Also in Turkey, of course, so some of these emerging markets are seriously affected by domestic crises, which is so true for some of the Latin American countries. Brazil may be improving compared to last year, but still has a lot of uncertainty around it. So, to your question, Brian, what kind of other risks are not on this list? When you think about risks, I think you basically have to talk about, what is the probability of a risk occurring and what is the possible economic impact of a risk occurring. So we already identified the most important ones, but the one we didn't talk about, which is in the news pretty much every day, is Brexit, which we're now probably really getting to the wire with regard to Brexit, as there apparently is a deal on Brexit between the UK and the European Union negotiators, but that doesn't mean that it will get done, because first of all, Prime Minister May needs to get it through her own cabinet, and then she will need to get it through Parliament. So it's still a big uncertainty that we're looking at. So that's definitely in the area of a significant probability of problems and a significant economic impact, which might very well go beyond the UK. So that's the one that I would put up. And the other risk that I would put up perhaps are, there are always these kind of geopolitical wildcards, whether it's North Korea or the Middle East or Russia, and these wildcards are always there. We never know how they're going to evolve. Most of them ultimately will not get to real disaster, but only one of them have to come up, and usually it's one that we didn't think about. That's the issue with risk. There are always these wildcards that we didn't think about, which are the ones that are going to hit us hardest. So that in a nutshell is the sort of overall global outlook and the risk that we're around it, but maybe this is a good time to actually dive a little bit deeper and go to Brussels and start with the European economy, where some of these risks are actually becoming pretty much visible. They're not just a theory, they're actually already reality. So Ilaria, maybe you can take us through some of the most important insights on the outlook from Europe.
Right, I'm happy to do that, and I only have very little time, so I'm not going to talk about everything that we put into the report. I recommend that you take a look. But I'll try to mention some of the important things. I know Brian wants us to stick as much as possible to the long term, so I'm going to start with that and just give the first important big figure. So we expect growth to be this year and next year in Europe to be around 2%, whereas if we look down to the long term, we are rather in the range of 1.4% for the next decade every year. So that picture that Bart, you showed at the beginning, it is a bit a picture that is a theme for our geo this year, actually represents the European economy really well. It feels like being on the top of the world. So the long term is expected to be slower, and of course, mainly because of capacity constraints. Now, it's very easy to talk about the constraints and the challenges for the European economy. So I'm going to make the effort of talking about the opportunities for the long term. There is a lot that can be said, a lot of weaknesses, but at the end of the day, the European economy is a big economy. So it remains an interesting place for business because it's made of, even after Brexit, so without counting in the UK, it's a market of 445 million people that are ruled by a single source of rules, by the single market. So it remains interesting. And at the same time, it's a very diverse place where you have countries with very different levels of GDP, labor costs, skills level. So you can, it's the place where you put together Denmark and Portugal, and you can build a very interesting and efficient value chain. And this is what has been done for the past 2 decades. And now we will see how this model develops, because there are some challenges there that we outline in Eastern Europe, in Central and Eastern Europe, where productivity is not growing as fast as the economy as we would expect and as we would like. So there are some challenges there, but still, European companies have managed that extremely well over the past 2 decades. And that's a big strength. And then, we always think of Europe as a very slow place, an old, slow place, but there are some pockets of dynamism. There are some countries that are younger, where the level of education of population is very, very high, where the market is extremely open, where the rule of law is the best. And so these countries remain interesting, even if we live in a continent that is aging and it's slower than the other regions. So this was about the long term. Now, as you said, there are risks in the short term, and we are in a moment of the cycle where, because we know probably the best has passed, people start looking around and wondering what's going to happen, where do I have to look out for risks. So we outlined some of those in the report. I will move to the next slide. Because I put here the first one, which is what came out also from the first poll question that you put out, and that's the tensions in the global trade system. This is important for Europe, of course, especially for the euro area, because it's a big the economic model is built around the export sector in many countries, and of course Germany comes up top of the mind. And we suspected in the last few weeks that Germany would be suffering from this, because you can see on the left hand of the chart here, there is the leading economic indicator for Germany that has been going down actually quite rapidly over the past year, and these past months are the ones that coincide with increasing tensions in trade. So Germany is suffering a lot, and one indicator in particular is going down quite rapidly there, and that's the orders for investment goods. And that's the main one driving down the LEI. So Germany is suffering, and then we saw today the GDP growth for the third quarter was minus 0.2. So this was actually even stronger than we expected for this quarter. So there's something there definitely to watch out for, because, as I said, Europe is a strong exporter. A lot of our wealth on this side of the world comes from the export sector. So that's definitely.
So let me ask you something, Ilaria, before you move on this trade issue. Because I understand, of course, that trade tensions are impacting on Europe too, but frankly, the key of the trade dispute is currently between China and the United States. So I wonder, is there not more going on? I mean, there's an overall trade slowdown. Not all of that may be related to the trade disputes and the US putting increased tariffs on China and the other way around. So to what extent are we dealing with a structural problem that European countries, and notably Germany, which to your point is so open to trade, is having a harder time to compete in that global environment? And to what extent is it really due to the short-term impacts of the trade disputes?
That's a very good question, Bart. We published a study at the beginning of the year where we argue that the trade growth that was very strong at the end of 2017 would not be sustainable. So I think we have a sort of base effect, because last year trade accelerated very rapidly in the second half of 2017, and now this is going down. And what we said some months ago is that there is a decrease in trade of intermediate inputs. And this was actually the bulk of trade growth in the period before the global financial crisis. So we see that going down. So there is something going on in the global trade system that is, as you said, it's beyond the trade tensions. But the trade tensions are definitely accelerating that, I think.
Just to quickly finish on that, do you think that Germany or Europe in general can actually benefit from the China-US trade dispute in terms of a redirection of trade to Europe, or do you think that's just wishful thinking on the European side?
It's difficult to say. On the one hand, we see in the data that Europe is suffering right now from the structural change and from the policy discussion and the trade tensions in the short term. The question, I think, is what happens in the medium term, whether indeed there is this trade diversion that would happen between US and China, that it's moved somehow to European, involves European companies. But I think that's an adjustment that requires more time, and that's why it's difficult to see if I think it makes sense to argue that, but we have to wait until we see traces of that. Okay, I'll move on to another completely different topic, which is interest rates. And this, I started to pick the brains of our members on that and had some very early discussions around this. So we put that as a risk for the short term because we know monetary policy in Europe will become more conservative in 2019 and 2020. So interest rates will have to go up at some point. And this, there is many people and many companies that have never lived in a moment where interest rates were higher because they've been extremely low, if not negative, for the past decade. So we put that as a risk because people might have lost the memory of it, and some people, I think, believe that low interest rates are forever, and this is not the case. And you can see on the right-hand side of the chart, there is a chart with the debt to GDP ratio of non-financial corporations in different European countries, and we decided to put that in the report because for three reasons. As I said, one is of course because interest rates are rising. The other reason is that if you look at the bar, the blue one, the darker blue, it shows the level of debt in 2009, so at the moment of the crisis, and it really shows that at the time the level of indebtedness of non-financial corporations was actually really quite high. And what is interesting is that over this decade, in some cases it increased further. So that can question the sustainability. I mean, if you think that interest rates will go up, we wonder whether everyone will be able to deal with that. And I'm looking at three countries which are particularly worrisome because they are the headquarters of many, many European companies. And that's Ireland, Netherlands, and Belgium, which you can see at the top of the chart with the highest level and strong increases of debt. We did a little simulation of how important is how much money servicing the debt requires. So you can see that on the left-hand side, where there is a little simulation. I mean, there is a past data, of course, and then a simulation of which share of revenue goes to service the debt, and that is expected to go from around 7%, which is the bottom and the lowest observed in recent times, and can double over the next 10-15 years and go up to 15%. And I understand from our members that if that stays that high for a sustained period of time, it can really question the sustainability of the debt.
That's true, Ilaria, but you can see on this chart during an earlier period that non-financial debt had risen much higher than that 15% number. So if we can keep the level of non-financial corporate debt to that 15% level, can that become a long-term sustainable level, or should we be much more concerned about that level? Is that going to trigger the type of accumulation that we saw right before the financial crisis?
Well, that was, I mean, I'm still into these discussions, in the early phases of this discussion. I'm trying to understand that. But what I understood so far is that, yes, you can deal for some time with 15%, but if that is prolonged, that can become a problem. The other thing that I understood from these early discussions is that a lot of companies, well, everyone is aware that interest rates will go up, but no one is taking measures to start to adapt. So, for example, to change sales target in order to meet, in order to create resources to pay, to service the debt. And I was a little bit surprised of that, so I'm happy we have that.
But I think that really depends indeed on how exposed countries are to short-term debt on the open capital market. And a lot of the larger companies actually are not very exposed to the open capital market. They finance a lot of their activity from their own balance sheets and everything else. I think it's particular a problem for small, medium-sized companies, but also medium-sized, that do depend very importantly on the open capital market. That's one point. The other point I would make is that it's certainly true that over time, to Brian's point, we have seen much higher debt-to-income ratios. But the other factor that we're not seeing here is the actual growth rate of the economy, because growth, of course, does help to at least deal with some of these debt issues. But if growth, as we will see later in our medium-term discussion, is going to be 1 percentage point lower than it was back in 1.5 to 2 decades ago, the 15% becomes a much bigger problem than it was at the time.
Good point, Bart. I'm going to move quickly to the third issue, the one that everyone is talking about today, which is Brexit. So I think the way to summarize the situation from the economic point of view in the UK is that both the short term and the long term are concerning. And I'm saying this because in the short term we see a high risk of recession. This is a clear message we get from our leading economic index, and we explained that already in the past 2-3 months in this webcast. So I will not enter into the details in the interest of time. But the other thing is that in the long term, it doesn't look too exciting either, because the average growth rate we expect for the next decade in the UK is 1.2%, and we were used to much stronger growth rates in the UK in the past. We also did a little simulation of what a hard Brexit would entail. And we try to communicate that in the easiest possible way. So in case of hard Brexit, you can see that the difference between the two scenarios on the right-hand side of the chart. In case of hard Brexit, there could be a difference in the income of every person in the UK in the range of $3,000 per year. So, I mean, this is just to give an idea of the difference. But I mean, this means it will halve the growth rate of the UK over the next decade, but it will have a tangible, concrete impact on the income of people in the country.
So we'll see how that's going to play out. Very quickly, before we move on to emerging markets, I can't avoid to ask you about Italy. Is it a short-term? Is the budget issues that we're now facing in Italy, is it a short-term problem? Is it a long-term problem? Or is it not a problem at all?
In Italy, it's always a short-term and a long-term problem. There's always an amount of drama involved in Italian policymaking, and that's quite high at this moment. But we should not forget that Italy has been growing much less than the average in the Eurozone for the past 2 decades. And that, I think, that's at the end of the day, it's always the biggest problem of in the Italian
So we'll watch it very carefully, because obviously there's a big political element to this as well. That's important to follow in the European outlook. Again, as we mentioned, in the interest of time, we have to move on. But each of those outlooks, actually, the European, the emerging market, and the US outlook, are documented in separate reports that are on our website. We'll show that at the end of the show today. But let's move on to emerging Asia. Stay in Brussels and move to Abdul. Abdul, obviously, this is a very large part of the world. I think we should start with the good news. And the good news is that these emerging markets continue to grow about twice as fast as the mature economies. So emerging markets is still where business has the greatest opportunity. That's the good news. The somewhat less good news is that there is increased risk and some visible slowing down in various of these emerging markets.
Yeah, that's a very good summary of what we see in the emerging markets at the moment. The report is about emerging Asia, but to start with, I will give you a flavor of what we see in the case of emerging markets as a whole, both in terms of short-term growth and long-term growth. So we see a moderate slowdown in emerging market economies next year, from 3.8% this year to 3.7% growth in 2019. But in going forward, we see a flattening of growth about at 3.7%, primarily driven by some uptick in Latin America, Middle East, and Sub-Saharan Africa. While emerging Asia, on which we are going to focus mostly on today, will see a little slight moderation in growth from about 5.1% in 2018 now which is an uptick, which will decline to 4.8% next year, and to 4.2% in the long term for the next 10 years. So what happens in the emerging markets is that again, in the short term, as we have discussed earlier, we have a number of risks, which includes the high oil prices, weak currencies in many of these emerging market economies, which makes their debt servicing and also their current account situation very worse, and macroeconomic fundamentals worse, and their inflation concerns rising and so on. But in the longer term, in the medium term, they have a number of different concerns across different countries actually. In China, the largest economy in the emerging Asian segment is going to continue its soft fall, as we call it, the Conference Board, given a number of issues, including its own internal structural dynamics. So it has been shifting from a more export-oriented, industry-oriented country to more service-oriented, domestic-oriented country. And it has been losing its cost competitiveness, which was one of the major attractive factors for China to attract foreign investors and foreign companies to excel their manufacturing in China. But now, given the high levels of debt and household debt, particularly in China, which is eating into consumers' purchasing power, and also its own shift towards more service-oriented economy, is providing less room for substantial acceleration in economic growth in going forward. So we are going to see a deceleration in China's economic growth in the next decade. India, which is the second largest economy, has substantial structural weaknesses domestically, including a lack of a solid manufacturing. So India has been excelling its growth since 2000s, primarily driven by its service sector, and lately more driven by consumers, while its investment growth has been weakening. Despite many efforts by the government, like Make in India program and so on, India has not been able to attract substantially faster rate of investment growth. So India also failed or it has been failing significantly in participating heavily in global value chain, which was one of the factors that helped China to move up and grow faster in the 2000s. So these factors, along with weak human capital and severe structural weaknesses, including infrastructural weaknesses, are going to be factors which will be a drag on India's long-term growth. One positive side for India will be its demographic potential, where it still have a high younger population, but that is not completely transformed into a quality human capital, which will be a big problem for India. Southeast Asia, as Bart was earlier mentioning, Southeast Asia is one of the region which is highly exposed to international trade, and any changes in the international trade, the challenges to globalization, is going to immediately translate into this region's growth, problems for this region's growth actually. However, this is a region which can also benefit from the ongoing trade between China and United States in terms of trade relationship, because some of the parts of the value chain activities which is now happening in China can be shifted to countries like Vietnam, for example, which is still benefiting or enjoying a least cost, labor cost scenario, and also have developing these countries are also investing heavily on developing their infrastructure. So if these countries continue in the path of infrastructure spending and human capital spending, I think some of these countries can actually attract some of those investment that is happening in China and benefit from the trade friction between China and the United States. So some of these structural weaknesses and these threats, both external and internal challenges, will feed into a moderation in the long-term growth in all these economies.
Right. So the next slide, actually, Abdul, we don't have a lot of time for it, but I think it's an interesting slide. It's sort of one point I want to emphasize, and because it's really bringing down this point of, yes, these economies are slowing, whether we look at China or India and Southeast Asia in terms of growth, but then the size of the bubble, which basically is the size of those economies, if you just compare that even with the previous period and going forward, that's, in my view, one of the most important medium-term trends, that the size of these economies becomes still very, very big. So these are very large markets. I would say, in a way, these markets are going to increasingly look like the markets in Europe and in the United States. They grow more slowly, but are really very large.
Yeah, that's very good point. I think it's a point which you also mentioned earlier, that we are of course we are seeing a slow growth scenario, but the companies should be now looking for markets which are actually rapidly expanding, and these are the markets. So there has been some projections about how it is going to be the middle class spending in the next 10 to 20 years. And by 2030, India and China are the largest countries which will have the largest share of middle class consumption spending in the world, overtaking United States, which is the leader at the moment. So even though you see that as we go from the left to the right of this chart, we see that the growth rates are going down, but you see at the size of the bubble, which is the per capita income or the average income of individuals in these countries, which is expanding. So this really tells you something about the market expansion. So the future market is definitely going to be in these countries, and these countries are more like current advanced economies. So,
and that goes back to sort of my main theme at the beginning, right? And that is that despite rising risk, companies are not backing off, particularly not in that part of the world, because the opportunities are so large to serve these markets, create such an enormous amount of growth opportunity, despite rising risk. So let's wrap up that last part on the rising risk. If you take those three large sections in the Asian economy, China, India, and Southeast Asia, for each of them, what is the biggest risk that can actually challenge the growth rate in the next years to come?
Yeah, so for all these countries, the current tightening monetary situation in the international monetary situation is a big risk for all these countries. For example, in China, in India, for example, or in Southeast Asian countries, the tightening of monetary policy in the United States will have a significant impact on capital outflow, because we have already seen that since the beginning of this year, almost $7 billion have been flowed out of India because of the currency weaknesses and the monetary tightening in the United States, which made U.S. Investment in the US much more attractive than emerging market economies. Now coming back to China, China has been trying to deviate its policy focus from growth to de-risking its financial sector, because it has been severely affected by mounting debt burden within China. So that has been an attempt recently, but now China is again trying to revamp its growth focus, but there is very little room for China to expand for a fiscal expansion and to support investment because of its high credit situation. So debt situation is a bigger challenge for China, and the second big challenge for China is the trade. At the moment, about 20% of Chinese income depends upon external demand, and of which 2% is related to domestic consumption alone in the United States. Consumption, I'm not talking about investment, but only consumer market. So there is a big challenge for China. If the trade relationship between China and the United States being hampered, it is going to have a major impact on China rather than on the United States. So that's the second major challenge for China. For India, as I said earlier, in the short term, the falling currency and widening deficits, which I have been already making earlier, has significant macroeconomic challenges. It's rising inflation concern in India. So India should actually be growing. It has a substantial growth potential, but it is growing at a smaller rate, and it is going to decline its growth rates primarily because of these short-term challenges. And what I also foresee is that this fiscal and current account situation is going to worse in the coming year, primarily because of the high oil prices, which is going to hamper its current account situation, and the government is going to focus mostly on populistic spending policies in the coming months, primarily because of the upcoming election, which is going to happen in May next year. So these factors are going to worsen fiscal situation in India. And finally, Southeast Asia, again, some of these issues like weaker currencies and global interest rate and inflation and rising oil prices are going to add to these countries. But again, a major challenge will be the trade war between the United States and China, and the long-term fall in China's economy, on which these economies are highly dependent, and also these economies are highly involved in the Asia's electronics and manufacturing value chain, which will be affected by the trade frictions between the United States.
Okay, thanks a lot, Abdul. A lot of good points. And again, you can go to our website where we have a special report on emerging markets. I'm also not going to touch in more detail on China. I'm going to skip through those 2 slides. May I just recommend that in 2 weeks' time, on November 28th, you can join our other monthly series, Window On. This will be entirely on China's growth performance with some China experts on the call. So that's a good opportunity for you to get up to date. I want to use, before we go to the medium term, which we want to spend some time on, Brian, but let's spend 5 minutes on the United States, which normally we spend a lot more time on during this webcast. Now it's a little bit shorter, but it's still a very important part of the world economy, and it has major impacts on the rest of the world, what the US is doing right now.
Absolutely. I think what you can expect is that the US economy is going to enter 2019 with a lot of momentum. Consumers are spending at a rapid clip thanks to very tight and strong labor markets, which are generating a lot of employment growth, some increased wage growth, and we're seeing that labor shortages, as Bart mentioned earlier, are most pressing in those blue-collar, so production, transportation, and low-wage service occupations, for example, in retail, and also in healthcare as well, where there was an expectation that many of these jobs might not even exist in 2019, but not only do they exist, but employers are having to pay more and more for them. So the fact that wages are increasing rapidly in these tight labor markets, that is going to put upward pressure on inflation. Already this year, the Federal Reserve has raised interest rates 4 times. I expect they will raise interest rates 3 further times next year. So not only are companies going to be contending with these higher labor costs, they're also going to be contending with much higher interest rates. And already those higher interest rates are having a real impact on residential construction and residential investment trends. We've seen a slowdown, actually a decline in the number of housing starts during the course of this year as individuals who might want to buy houses are unable to do so. And that's also going to play a role in business strategy in 2019. The tax cuts last year did generate some increase in investment, but now firms are going to have to pay more in order to borrow capital, and that's also going to increase the risk of business failures. And that also is going to affect consumer behavior, especially in terms of products such as automobiles, where higher capital costs, higher interest rates has a real effect on overall demand. And I think one key thing to keep in mind from a medium-term perspective is these labor market conditions, barring a rapid increase in productivity, are not going to change anytime soon, because the US is undergoing a demographic shift. Like many mature economies around the world, there are going to be fewer and fewer new workers coming on board. And so that's going to mean that these challenges that tight labor markets are presenting now are going to very much shape the future. And firms are going to have to figure out ways of becoming more productive, making those R&D investments, incorporating those new technologies, and figuring out better business practices in order to leverage those technologies. And then finally, a word on trade. I think there was some degree of relief in terms of what came out of the US-Mexico-Canada agreement. It's not called a trade agreement, but it's essentially the successor to NAFTA. But there's still a lot of risk from a supply chain perspective in terms of what is going to happen in terms of the US-China trade relationship. And that is a big mystery. That's about some long-running issues, intellectual property protection. I think most important, the question of what right will U.S. and Chinese technology firms have to operate in the other country? Will we start to see a degree of data and technological balkanization in some of these incredibly exciting industries?
Brian, very quickly, the thing that you're not mentioning here is the midterm elections, which are just passed last week. We actually did a separate webcast on that, which is also posted on our website, as well as a podcast that's coming up very soon. But if you very quickly, three most important policy areas: fiscal, regulation, and trade. Are you expecting, very briefly, major changes in any of those three policy areas in the next 2 years compared to the first 2 years of this administration and Congress?
So let's first talk about fiscal policy with the help of this overall GDP growth chart, which shows in the black line the rate of GDP growth that we can expect. And you can see that GDP growth has peaked in the second and third quarter of this year and will start to decline throughout next year. And the reason for that is the fiscal stimulus with which the Trump administration was able to pass through, both in terms of tax cuts and increased government spending, that the impact of that is going to dissipate during 2019. So you can see those red bars, which reflects the contribution of government spending to GDP growth. That's going to exert a large impact during the first half of 2019 and a much smaller impact during the second half of 2019. I think the results of the midterm election can confirm that picture, because what divided government means is that it's unlikely the Trump administration will be able to pass further tax cuts. It's unlikely that we'll see increased federal spending because even though the administration and also House Democrats might be interested in increasing infrastructure spending, that's less likely given the increased deficits that the current fiscal policy has led to, and also concern among Senate Republicans about the impact that all that spending will have on the long-term sustainability of U.S. debt. So I think when thinking about next year, first of all, it also, from a regulatory perspective, I would not expect that much of a change, because most deregulatory actions, those are coming from the administration itself. There will even be some rules coming through, particularly on environmental policy, that will have an impact. In terms of trade policy, what I would expect is that there will be some controversy about ratifying the USMCA agreement. I think ultimately the changes are small enough outside the auto sector that it does get done. But I think by and large, the administration is going to be driving the process of how the U.S.-China trade relationships evolve over time.
Okay, so there are two questions online, and then I think we need to move on for the sake of time.
Okay.
But they're both related to the U.S. First of all, how might increased infrastructure spending and deficits to support expenditure impact the growth picture? So that is one question. And the other question is, some economists are talking about a growth recession in 2020 for the U.S. How does that fall on your radar, on your risk radar?
I think in terms of the infrastructure question, key thing to keep in mind is we talk about productivity in this room. And the administration made a very clear choice to try to boost productivity by making investment and capital costs cheaper for a period of time, and not really trying to encourage that money to be spent on R&D or to promote infrastructure that might help enable digitization, thinking about 5G networks, thinking about how do you build cities that are more conducive to autonomous vehicles, alternative sources of power generation, and things like that. And so we'll see over the next few years whether that choice ends up leading to higher productivity growth, because it's going to be very, very difficult in light of current fiscal positions to fund the type of infrastructure spending, barring, I think, a recession where the crisis and the level of unemployment, that could end up providing the impetus for greater infrastructure spending. But I think barring that, I wouldn't expect a lot of infrastructure spending. And on the second point, the question of a growth recession, I think that's synonymous with the idea that growth could be very slow in 2020. I think that's a perfectly plausible outcome. I think even a recession is a perfectly plausible outcome. Firms are going to be at more risk of failure as a result of these higher capital costs. As Ilaria said, they're going to have to contend with interest rates they haven't had to contend with in living memory. And so that's going to result in a riskier environment for profits.
Okay. Before we go and spend our last couple of minutes on the medium term in a bit more detail, Abdul, two quick questions that I'd like you to deal with. First of all, your predictions for the Indian currency, and do you expect any depreciation against the US dollar? And the second one, the outlook for oil prices. I mean, oil prices have been coming down in the last year. They're very volatile at the moment. What's the outlook sort of over the next 3 years?
Yeah, so but, to take the first question, I do think that it is very likely that the value of Indian currency will stabilize in the coming months. Primarily because one of the main concern was that the U.S. sanctions on Iranian oil import to India was a major concern for India. So since the United States have waived India from that sanctions, I think that concern is easing now. So that will be a relax for India. So I think it is very likely that the currency will be stabilizing rather than further depreciating in the coming days. So the second question was on
the projection for the oil price in the next 3 years or so, underlying our outlook.
Yeah, so we are seeing some decline in the oil price at the current moment, and I think I do not see that it is going to decline rapidly and significantly in the going forward.
Yeah, actually, demand is going to drive obviously all of this, and actually this is a good transition to this slide here about our medium-term outlook. These are the last two columns here. And we're seeing this sort of, if we just focus on the global picture for a moment, this sort of gradual slowdown from 3 to 2.8%. But frankly, that's still an environment in which demand is strong, and it goes back to the issue of the rising middle classes that Abdul addressed before. Because these rising middle classes, even with growth getting slower, these rising middle classes are big consumers of energy. So we should not take this sort of macro growth picture as a sign that therefore the demand effects on oil prices will come down. If anything, I think there will still be upward pressure, although certainly there is a lot of volatility on the supply side too. What I'd like to do now is to shift a little bit to this medium term and try to understand sort of, what is exactly driving this gradual slowdown of the global economy. Those don't look like very large numbers, 3 and 2.8, but an 0.2% decline in global growth is actually no peanuts. So we need to think what's behind it. And we thought to structure this discussion for the last couple of minutes, we start with our last poll question and ask the audience actually about what of the drivers you think will exert the greatest influence over medium-term growth trends. So that is not coming up on the screen right now. What drivers do you think are having the greatest influence on the medium-term growth? Is this technological change? Is it convergence of emerging markets? Is it challenges to globalization? Is it environmental risks? Is it income inequality or other types of wealth inequality? Or is it the debt issues and the imbalances that we're seeing in debt? And that we will use a little bit as a transition into our final discussion on the medium-term impacts. So I leave this open a little bit for you to think about what the most important drivers are going to be for have the greatest influence. Technological change, emerging market convergence, so emerging markets growing more slowly, challenges to globalization, environmental risk, income inequality, or debt imbalances. And we give it 5 seconds. 5, 4, 3, 2, 1, and we're going to stop right now. So basically, again, close to half of you who also were very concerned about trade disputes see the medium-term impact of this, which is the challenges to globalization. As we quite often say, the trade disputes are perhaps only one chapter in the book of deglobalization. After 2 decades of rapid globalization, we're basically seeing a trend of reversion that doesn't only focus on trade, but also on immigration, for example, or foreign direct investment and the barriers to invest in other countries of the global economy. So 50% of you, close to 50%, think that's important. On the upside, quite a few of you, a quarter, thinks that technological change is actually the key variable. And I think that is critical indeed if we move on to our overall overview of these medium-term trends. and that should be coming up on the screen right now, then indeed technological change is a critical factor. But it is kind of offsetting itself against the other critical factor for growth, and that is demographics. And this is really, in our view, probably the most important factor we need to think about. Labor supply is going to slow down because the global population is going to age. That's already very visible in Japan, in Europe. It's becoming visible in the United States. It's very visible in China. And even though emerging markets still have this demographic dividend that Abdul referred to earlier in relation to India, that demographic dividend will gradually begin to erode also. So we have a slowing labor supply. And the way to make up for that is to make sure that the workers that are still there are becoming more productive. And that's what's the result of technological change, the second point on this slide. And if you take those 2 points together, there is certainly some reason for optimism, which is that yes, we will have more digitization in the economy that is driving productivity growth, that is somewhat visible in the numbers, but it's probably not going to be enough to offset that slowdown that we're seeing on the labor supply side. And I think that's a very critical factor that is underlying this, this first and this second trend, aging of the population, show labor supply versus productivity that is coming from technological change. Now, there are a few other things, Brian, maybe you want to pick up a few other things on this slide that you think are important feeding into that medium-term outlook of slowing that you would like to address here.
So I think the question of inequality is a good way of framing the concerns about technological change. Because deploying new technologies for the benefit of productivity growth is not simply a matter of developing those new technologies. It's going to require public acceptance of a new level of cooperation between business leaders and government officials. And if that's perceived as further accelerating the rise of income inequality, of destroying good job opportunities for the vast majority of the labor market, of jeopardizing data privacy, of allowing consumers to be taken advantage of, then it's going to be much more difficult to deploy those new technologies in a way that is given public acceptance and public approval than simply the task of developing those new technologies.
Right. Let's go to our colleagues in Brussels. It's going to ask each of you to pick up one of those medium-term trends that you would like to address most. Ilaria, let me start with you. Of this list, or perhaps something else that's not on this list that you think is critical to think about the medium term.
I would say all of the above. That was my answer to the to the poll. Now, jokes aside, no, I think it's really aging when it comes to Europe because it's together with Japan is the continent where the demographic change is very aggressive and it's in a very mature state. So I think that's aging would be my pick. But I think there are a couple of interesting things. We see that labor productivity goes up. It's going up in reaction to that. So that's what we include in our forecast. That's the natural reaction of the economy. You have potentially fewer people, and the same people have to produce more to keep the same level of income. But perhaps not enough. I mean, we would like productivity to increase even faster, and that's where technology comes in and the whole discussion whether we will see the fruits of the digital transformation in the next years or not. But I don't think I have time to go into this.
And Abdul, from an emerging market perspective, when you look at the medium term, which point would you pick up?
Yeah, actually, I will not pick up one single point because I think there is a correlation between some of these points, significant correlation, and I was a bit surprised to see the polls not giving enough or high share to the emerging market convergence. And later, I did realize that it is also because it is highly related to the globalization challenges, because the globalization challenges will also feed into the emerging market growth slowdown. But the other two things which I wanted to relate to this is inequality, globalization, and a richer but slower world. So when we say earlier also we made the point that emerging markets growth is slowing, but they are becoming bigger and bigger market. But one factor that could limit that process is widening inequality within economies. So after the globalization process has started, we have seen inequality has declined across countries, but inequality has been declining, increasing within countries, including in many emerging market economies. So this will be a constraint for many emerging market economies in going forward and in expanding their middle class base, also income base.
Thanks, Abdul. I mean, there's a lot more to talk about, and we could definitely spend a whole other hour on it, which we can't. But the good news is that there's a whole portfolio of material where a lot of this is written up. For that, you just need to go to our website, conferenceboard.org, data, global outlook. You find the actual data there, country by country. That's a good thing. But the other thing is you find the various documents on which a lot of the discussion today was based on. So please go there. It's all available right there for your benefit. Of course, we're going to come back and continue this kind of discussions in our ongoing webcast. Next month, actually, you'll see two of the speakers today back, Ilaria and Brian, but they will then be joined by Ataman Oziyadarim and Gad Levanon. They will be talking again about a topic that's closely related to the whole trade issue and has to do with global versus local sourcing and how supply chains are going to be changing. And there's some interesting research that we're carrying out that I'm going to address. And then finally, I'll just point you at some other related resources at the conference board, including the webcast in 2 weeks' time that I mentioned earlier that is going to focus on China. So please go to our website, register for that one, and you get a whole hour entirely focused on China from a China perspective. So that's going to be great as well. With that, thanks a lot for the team today to cover the whole world in an hour time. That's very challenging to do, but you did a great job. Thank you for joining, for your interesting questions, and we'll hope to see you again very soon on Economics Watch. Don't forget about the evaluation, because we always like to hear from you how we can make this program as good as possible for you. I wish you a good day from New York. My name is Bart van Ark, Chief Economist at the Conference Board.